So let me start by saying that I'm Brian Feldman. I'm a Maryland State Senator, represent the Maryland suburbs of D.C., that part of Maryland, and I'm the Vice Chair of the NCSL CFI Committee, the Communications, Financial Services, Interstate Commerce Committee, which has jurisdiction over this issue. In today's program, we've entitled Cryptocurrency, Currency of the Future, or Just a Fad? Hot topic around the United States. I think it's reflected here in a good turnout. Let me just start, but when I say a hot topic, just show of hands. Who here, or how many of you have considered at some point recently investing in virtual currencies or an initial coin offering? Just raise, okay. And that number's probably a year from now going to be a bigger number. So digital currencies, what we're talking about here today, are cryptocurrencies, digital assets created by complex computer algorithms. Unlike, as I'm sure many of you know because you're here, dollar bills and coins, cryptocurrencies are not issued or backed by the United States government or any other government or central bank. This lack of physical token confuses some people and makes a lot of other folks very, very nervous because we're in somewhat uncharted territory. Now, a lot of people know about Bitcoin. It's best known of the cryptocurrencies, but the reality is about 60% of the cryptocurrency market value today is in tokens other than Bitcoin. So this is, again, a growing issue. So today we're going to hear an overview from a fantastic panel we have to my left, an overview of the technology, discuss all the potential and challenges. Specifically, I'm hoping we'll talk about the impact of this on our financial institutions and the financial system, quite frankly, as a whole. The issues of investors, fraud, particularly with the advent of initial coin or initial token offerings that I mentioned earlier. How does our existing regulatory framework, both at the federal and state level, fit within what we're discussing here today? And how can federal and state regulators stay on top of these financial innovations? And so I was told to remind everybody that any recording, this is lawyer, any recording of this session is prohibited unless previous approval had been granted by our crack whip NCSL staff communications division. Also, we're going to want this session, when the panel is done, to be very interactive. So the bottom line is this: we're going to be live streaming this, and so be very careful what you say. This is going to go out to the entire world, so just be mindful of that. So let me, I think what I'm going to do is I'm going to introduce each of the panel in their entirety, and then we're going to go back and they're going to do 10 minutes each, and then we're going to open it up for some Q&A from the audience. So first, we've got to my left, Peter Van Valkenburg, who's a research director from the Coin Center in Washington, D.C. Peter's the director of research at the Coin Center, the leading nonprofit research and advocacy group focused on the public policy issues facing cryptocurrency technologies such as Bitcoin and others. At the Coin Center, Peter drafts the center's public regulatory comments and helps shape its research agenda. He's testified before Congress, briefed staff members of the EU Parliament, and educated policymakers and regulatory staff around the world on the subject of cryptocurrency regulation and decentralized computer systems. Previously, he was a Google policy fellow and collaborated with various digital rights organizations on projects related to privacy, surveillance, digital copyright law. Peter's a graduate of, among other things, NYU Law School. To his left, we've got Lucinda Fazio, I think goes by Cindy, is the Chief of Regulatory Affairs of Consumer Services, the Department of Financial Institutions from the state of Washington. Again, Chief of Regulatory Affairs for the DFI, Division of Consumer Services. In that capacity, she assists the division director in policy matters, coordinates legislation and rule writing for the division's 7 regulatory programs, provides guidance to the division. Cindy is the chair, also the State Regulatory Registry Lawyers Committee, is active in several other state organization committees. Prior to coming to DFI, she was a staff attorney for the Washington State Senate, which I like that background a lot, public defender, and an assistant county prosecutor and a contract attorney in business law. She's a graduate of Boise State University and the Seattle University School of Law. Was that inaccurate or accurate? Okay, it's all good. Andrew Beal, moving on next, is a senior manager at Ernst & Young out of the San Francisco office here on the West Coast, as their lead person for the firm's blockchain and cryptocurrency advisory practice, leading client engagements in the financial service, healthcare, and life sciences sector. Andrew's also a cryptocurrency subject matter expert for the firm, supporting tax and audit engagements involving those assets. Prior to joining Ernst & Young, Andrew was a corporate attorney focusing on mergers and acquisitions, venture capital financing, and securities. In addition to providing general corporate counsel to emerging technology companies, Andrew advises virtual currency companies on a wide range of state and federal regulatory issues, including anti-money laundering, General Bank Secrecy Act compliance, and state money transmitter licensing issues. He's represented virtual currency exchanges, wallets, payment processor, cryptocurrency developers, and foundations, cloud miners, and ATM operators. Earned his bachelor's degree from Loyola University in New Orleans and his JD from Loyola Law School right here in Los Angeles. And finally, to the far left, we've got Michael Pichek, who is the commissioner of the Vermont Department of Financial Regulation. He was first appointed by Governor Peter Shumlin in July 2016, reappointed by Governor Phil Scott in December 2016. The commissioner serves as the chief regulator of Vermont's financial services sector, including the insurance, captive insurance, banking, and securities industries. Commissioner Pichek is president-elect of the North American Securities Administrators Association, a member of the SEC Advisory Committee and on Small and Emerging Companies, and a member of the National Association of Insurance Commissioners. Commissioner Pichek grew up in Brattleboro and graduated cum laude from the University Union College with a degree in political science, received his law degree from the University of Miami School of Law. And so we're going to start, I think, with Peter to my left, who's going to provide an overview of how virtual currencies work and the regulatory framework broadly. And then Cindy's going to discuss the regulatory perspective of state financial institution regulators. Andrew Beal will then provide information on what cryptocurrencies are being used for, how business and governments are responding, and whether government can keep pace as the technology develops. And then batting cleanup at the end, Michael's going to provide the regulatory perspective on initial coin offerings. And then, as I said, we're going to open it up to questions, discussion. We've got a mic in the middle, so probably invite you up to that mic to throw some Q&A to the panelists. So with that long introduction, I'm going to start by passing it over to Peter to get us going.
Thanks so much, Senator Feldman. So I've been tasked with both giving you a background on how cryptocurrencies and tokens work and an overview of the regulatory landscape in less than 10 minutes, which is something I've tried to do a few times and it never quite works out, so I'm going to abbreviate some of these things. I often think that these are new technologies that are very complicated, and you can think of trying to explain to somebody how cryptocurrencies work like trying to explain to someone in the early 20th century how an automobile works. There's two ways to do it. The first thing you can do is reason by analogy and explain what it's supposed to do. You say it's a horseless carriage. Now that sounds crazy to somebody who doesn't understand innovation with automobile technology, but it at least gets the message across as to what the hell this thing is and what it's supposed to do. The second thing you can do is then explain all the working parts of an internal combustion engine, which can't be done in 10 minutes. Blockchains and distributed computing technologies are at least as complicated as an internal combustion engine, and they're just as novel as those technologies would have been back in the early 20th century. So instead of giving you an overview of hash-linked data structures, elliptical curve, digital signature algorithms, and all that, I'm just going to tell you what these things are intended to do. You'll have to take my word for it that they work, Coin Center, the organization that I work for, has a number of more in-depth resources that explain the nuts and bolts of how they do what they're supposed to do. And our website has all those resources on it, coincenter.org. A little brief aside about what Coin Center is. We're not a trade association. We're basically a think tank in Washington, D.C. that's focused exclusively on this policy area. We don't represent any companies in the space. We have our board of directors and our internal team sets our agenda. And what we're really trying to do is get good information about the technology in front of policymakers so that they can make good policy and avoid making bad policy out of ignorance, because that's, in our experience, where most things go wrong when it comes to regulation, not out of malice or a desire to destroy the technology, but rather just a poor understanding of it. So again, coincenter.org, you'll find many more resources. So what is the real innovation behind Bitcoin, cryptocurrencies, tokens, this whole unfolding ecosystem? I'm going to explain it with respect to two parts. So first, a show of hands, how many people in the room are familiar with the distinction between bearer instruments and registered instruments? Okay, not bad. So a bearer instrument is like a $100 bill or an old bond with coupons that you can cut off of it, or a stock certificate, back before we used to register all of our stocks, basically. And the idea behind a bearer instrument is whoever shows up with it gets the value of it. It's honored. It doesn't matter if you're not the name on it, if you're not in some database somewhere as the owner of it. Whoever's holding the physical thing, the bearer instrument, is owed the value of the instrument. A registered instrument, by contrast, is something where you have a registry, and those will look like things like the DTCC, for example, the clearinghouse that handles most stock certificates in the US. And there, the value of the thing is owed to whoever is in the registry. Doesn't matter who shows up with a certificate and says, hey, I should have this. It matters who's in the registry. And we moved from a world where most trading and markets was run off of bearer instruments, i.e. stock certificates that people would actually hold, or cash that people would actually hold, to a world of primarily registered assets. Anyone familiar with the term dematerialization? Show of hands. This is this idea that we should stop having paper because it's grossly inefficient to have paper. We should switch to just data about trades, data about ownership. And the way we did dematerialization back in the 60s and 70s and 80s was getting rid of the paper and building databases. And the database listed, all right, this share of Apple is owed to Peter. This share of Sprint is owed to Andy. And that's how we knew who had what. It wasn't who shows up with the paper, the bearer instrument in their hand. It was about the registered instrument. Now, the amazing thing about Bitcoin, cryptocurrencies, and tokens is it sort of reinvents the bearer instrument, and it gets rid of a lot of the inefficiencies of old paper bearer instruments because it's a digital bearer instrument. And what I mean by that is this. If I have a Bitcoin, I have it on my phone, potentially. And when I say it's on my phone, I mean it's on my phone. Not like $200 that I have in my PayPal account, which shows up on my phone, but really PayPal's holding the money. But rather $200 worth of Bitcoin that is actually on this piece of physical hardware. And if I want to send it to Andy, Andy can show me an address, which he generates on his phone, and I can take a picture of it with mine and send the $200 worth of Bitcoin from my phone to Andy's phone with nobody in between. No bank, no company, nothing but peer-to-peer networking software on the internet. And that is a real revolution because what it enables is this sort of bearer asset again, where I have the $200 worth of Bitcoin here. It's on my phone. It's not something that somebody in the world, like the DTCC or Bank of America, says that I have. It's actually something I have. But unlike a paper bearer instrument, I can send it to Andy over the internet. I don't have to meet in person and hand him a piece of paper. I can send it to him over the internet. I can send it to him over the internet even if he's in Singapore and I'm here in LA. And that provides sort of radical new opportunities for how we choose to architect markets. And this really didn't exist before Bitcoin. Bitcoin was the first, if you will, digital bearer instrument. And the reason for that is fairly intuitive. If you think of a $200 Bitcoin, worth of Bitcoin, if you think of it as like a file that you would attach to an email, so this is before Bitcoin. We have email, which is peer-to-peer. And I say, hey, Andy, I sent you an email with $200 attached to it. It's an attachment. It's like a picture or a Word document. We all understand why this wouldn't work. Andy would say, what the hell are you talking about? That's not $200. You just sent me an attachment, and you could copy that attachment and send it to 500 other people, and now $200 became, well, I've made my math hard, 200 times 500, a lot of money. So counterfeiting makes it impossible. The ease of copying things on the internet makes it impossible to have that kind of digital bearer instrument. But Bitcoin solved that problem. Now, if I send Andy my $200 worth of Bitcoin, he knows with assurances from the decentralized network, from the cryptocurrency network, the Bitcoin network, that I've given up that $200 worth of Bitcoin. I can't send it to somebody else. So that's really the core innovation here. And how it achieves that is also interesting. So the way it achieves that is there's this distributed public ledger of all the transactions. And it can be independently verified by people all over the world. You don't have to be a specialist to verify it. It's just math that is required to verify it. Publicly available functions and math. And what's interesting about that is you took the job of the remember my talk about registered assets. You took the job of, say, the DTCC, which is to handle a registry of assets, and you turned it into something that anybody can do around the world. And that's basically what Bitcoin does. So instead of there being one record kept in a building in New York City that the DTCC owns, the record is kept on computers all around the world by anybody who wants to join the network and help keep the record that says that I gave up my $200 worth of Bitcoin to Andy. And you might say, well, why would anyone join that network and help keep that record? Well, it's because they're able to basically claim a reward from the network for providing that public good. This really is public infrastructure. And that reward is, when you're talking about Bitcoin, the mining reward, it's a certain number of brand new Bitcoins that if you did provable work keeping that record, you can claim as your own on the network. And how can you claim it as your own? Well, you're helping to maintain the record on the network. So if you verifiably maintain the record, you just add a record item that says, I get this many new Bitcoins as a reward for doing this work. And you might say, well, what if you fake the work? Well, that's where complicated math comes in, where people who try and fake the work will be ignored, and they can't give themselves the reward. So I just hit 10 minutes, and I only got to explaining two ways of thinking about Bitcoin, which are decentralized systems, like a decentralized DTCC, where anybody can perform the work of keeping the registry, and digital bearer instruments, which is a way to think of it. And so real quickly, the regulatory landscape, I'm going to go over a minute. I'm going to do that in 1 minute. So there are basically four big issue areas with respect to digital currencies, tokens, et cetera. And these are consumer protection, investor protection, anti-money laundering policy, and tax. There's others, but those are the big four. Consumer protection generally is a state affair these days. So a lot of companies will start businesses where they're holding people's Bitcoins for them, which puts them in a position of trust with respect to their customers, trust that can be betrayed. So you see these stories about exchanges being hacked. That's an example of betrayed trust, either negligence or malicious but betrayed trust. And so that act of holding people's Bitcoins is rather like being a sort of bank, but none of them are chartered banks. And it's rather like also being a sort of money transmitter, like PayPal or Western Union. And so several states, Washington among them, have decided makes perfect sense, and I'd agree, to regulate those custodial exchanges who hold people's digital currency for them as money transmitters. Other states have tried to create brand new licenses, like New York with the BitLicense, and some states are still just sort of dithering on the matter, whether or not they're going to give licenses to these exchanges or not. And California is actually one of those. The next issue area from consumer protection is investor protection. These cryptocurrency networks are open source software, which means anybody with a computer and an internet connection can copy the code and start their own cryptocurrency as long as they convince a bunch of other people to run the software. Just like there's people running Bitcoin software, I could make some changes to the Bitcoin software, call it PeterCoin, convince 50 of my friends to run the software, and now I've made PeterCoin a cryptocurrency. Now, some people are pre-selling their brand new idea for a cryptocurrency before the network even functions. And that activity is rather like issuing a security, quite frankly, because you're relying on those people to make that thing that they're promising valuable, and the only people buying it generally are people who are hoping to get rich off of it, not people hoping to use it for something like money transmission. The next issue area, anti-money laundering. So here, what's mostly oh, and by the way, securities law, of course, it probably doesn't need for me to say, but is both a state and a federal affair. And the SEC's taken some steps to clarify their perspective here, and some of the states have started to wade in as well. AML is primarily a federal affair. FinCEN is the division within Treasury that handles Bank Secrecy Act compliance. Money transmitters that are state licensed are also required to get registered at the federal level and do know your customer and suspicious activity reporting. And by and large, we've seen all the exchanges actually register with FinCEN, do know their customer policies, risk calibrated anti-money laundering policies, and file suspicious activity reports. In fact, we've spoken with folks at FinCEN and at law enforcement who say that the suspicious activity reports they get from virtual currency companies are actually better than the ones they get from mainstream financial institutions, because the data is just all there and usually nicely laid out. And finally, tax. Tax is extremely complicated because it's unclear exactly how these assets are going to be treated. The IRS came out and said that they're going to be treated as property, but there's still residual questions, which we probably won't get to on this panel, but I wanted to flag that issue area. So apologies for going a little over.
Thank you very much. I'm very happy to be here this afternoon and hope I can help add some information to this very complicated matter. In the great state of Washington, and I am only speaking for the great state of Washington, and furthermore, my comments are not actually on behalf of the great state of Washington, but are only my comments, unless I am referring specifically to the law or rules. We started looking at virtual currency and other digital currency issues back in 2013 when we were starting to be inundated with questions and comments about that. We looked at it for a couple of years in Washington internally, and we decided that it did in fact fit within an existing statute that we implement called the Uniform Money Services Act, and it falls under the definition of money transmission. So we put out some interim guidance explaining to the world our thoughts about it and where we planned to go with it. And we let that interim guidance sit out there for a time, took comments from people, watched the industry, I should call it not an industry, but the ecosystem, watched it evolve, and we finally got to the point where we were secure in that our interim guidance did in fact reflect consumer protections, anti-money laundering protections. It met our mandate under the law for the activity needing to be licensed and regulated. So we amended the statute itself to clarify those things, and we worked very closely with industry. We had multiple conference calls, we had multiple comments from industry, went forward, amended the law, and then proceeded to follow that with some further clarifications in our rulemaking. So we have always been, in the state of Washington, very interested in the business innovation and the amazing technologies underlying this ecosystem. And again, we're only looking at the if you want to, it's always helped me a little bit to think of blockchain is the underlying platform. I'll call it a software platform. Bitcoin is just one application that runs on that platform. The blockchain actually has many other applications that may in fact turn out to be better suited to other things, and I think you're all seeing a whole bunch of different use scenarios for blockchain among all the states and among other countries for that matter. So we feel very secure that we have struck the right balance in our state with our regulatory approach for consumer protection, anti-money laundering. Our state has also opined on the tax piece of it. And we were further happy to see the federal regulators in the spaces of the the Commodities Futures Trading Commission and the SEC. We were very happy to see them own what seemed to be logically their piece of it and take part in that regulatory effort, because we believe that the more that the underlying activities, when they're examined for what they are, if they are in fact securities, if they are in fact money transmission, if they are in fact storing value for another person, that those underlying activities themselves are not new and that they're regulated in a way that business can understand and continue to innovate with. So we have seen different approaches among the different states, and I think that's going to continue to evolve. And I think that we are moving towards harmonization. Washington has always considered itself to be hopefully making good policy based on knowledge, not the bad policy based on ignorance. And we always welcome the help from the industries that we regulate. Those are the subject matter experts. And wanted to give one more plug for the great state of Washington. We did implement a multi-state licensing agreement within a number of states. We have 18 states now where we all are looking at our Uniform Money Services Act, and we are trying to harmonize the statutes around those issues, and we are in the pilot phase of that process, and we have heard accolades from industry, and I hope that the states can continue to harmonize where we can to continue to protect our citizens and foster innovation in our states and keep a healthy state regulatory system in place. Thank you.
Hello, everyone. In typical consulting fashion, I brought a PowerPoint presentation. I promise, though, these are going to be brief and hopefully interesting. So I always like to start off with something fun. And I have some statistics here that quantify the demand for cryptocurrencies in the market, which is, as Peter alluded to in his comments, is really the driver for a lot of this adoption. So I want to highlight a few things here that I was looking at last night that I thought were particularly interesting. The first one is that 30% of millennials would rather invest $1,000 in Bitcoin than in a government bond, which may or may not surprise you. They are also twice as likely to buy cryptocurrency as any other age group. And there was some discrepancy on what exactly a millennial was. The consensus seemed to be that it was folks between the ages of 22 and 37. So that's me, and many of you in the room as well. And so that's on the retail side. What about the institutional side? So there are 251 hedge funds now that invest exclusively in cryptocurrency. We call these crypto funds, and they have an estimated $5 billion in assets under management, and that's probably a very conservative estimate. Not all of them publish earnings reports, so that number could be higher. Interestingly, of these funds, 200 were launched since the beginning of 2017. So if you think about what that looks like on a graph, it hockey sticks after January 2017, which also coincides with the massive increase in price over the last 18 months. The third stat here is about exchanges. So Peter mentioned the exchanges earlier. A lot of these businesses are also approaching Cindy about licensing. As of April of this year, there were over 500 cryptocurrency exchanges worldwide, which may not sound like a lot, considering how many countries have users of this technology. But to put that in context, as of September 2016, there were only 48 exchanges. So I would sum up these statistics the following way. There is an insane amount of demand in the market for this new asset class, and it absolutely is a new asset class. That demand is fueled by a desire to speculate on these assets. They certainly have the means to be used as, the capability to be used as payments, merchant payments, cross-border payments, traditional money transmission that you guys are probably familiar with. However, for a number of reasons, a lot being that these networks are still very young and lack a lot of the scalability needed to sort of operate on an international level. They are predominantly used as vehicles for investors to speculate on. And so the exchange community sees this demand and is trying to meet it in the form of new exchanges. There are thousands of these assets now out there. Things like Bitcoin, like Peter said, have been copied, what we call forked, created new assets that look very similar, functionality-wise at least. There are other platforms that have slight tweaks. There are others that are very, very different, quite frankly, and have very robust capabilities. They also have a token aspect, and those are also traded. So there are thousands of these assets that are traded. Not every exchange trades all of these, but you can see how an exchange can sort of make a niche in a particular country or with a particular subset of these assets. So these exchanges are wildly profitable, but the majority of the volume is on sort of the top 10, which is probably not surprising. So how is the business community responding to this demand in the market for these assets? With the "if you build it, they will come" approach. The exchanges have obviously sort of followed this statement, and you are seeing traditional finance do the same thing. So asset managers, custodians, broker-dealers, investment advisors, fintech payment companies, and traditional banks and investment banks are all seeing cryptocurrency as an asset class that they want to support. And I think a lot of that is due to the fact that, if you remember the first slide I showed you about millennials, that is a market that is extremely valuable to the financial industry. So if there is an asset out there that the majority of 22 to 37-year-olds are really interested in buying, then a bank, a payments company, an investment platform, an investment advisor that allows those users to buy that asset on that platform, they're going to do it, right? So interestingly, since hedge funds have also gotten invested in this asset class in a big way, they have also driven, I think, a lot of the regulatory dialogue because they themselves are regulated entities, unlike a lot of the individuals that are buying and selling this. And they need certain things to be in place to be able to sort of to buy, sell for themselves and also their investors in a compliant way. So hedge funds need to custody assets to some extent with a quote-unquote qualified custodian. They also need other service providers, for reporting and tax and other things. So that side of the industry is being built out as well, and and that activity is generating, I would imagine, a lot of dialogue for Cindy and others at the federal level too. So I'm going to put my crystal ball hat on here for a second. So where is all of this going? There's been a little discussion about sort of the underlying technology here, which is blockchain and some of the potential applications that extend beyond cryptocurrency. At EY, we are seeing a lot of these applications, and I want to sort of sum up all of this in kind of a thesis statement that I personally believe, but also EY believes as well, which is that everything that can be tokenized will be tokenized for a number of reasons. One being that something that's tokenized in a digital form is just far easier to transfer. But we are seeing tokenization take hold in the securities markets. We're seeing it take hold in commodities markets, derivatives, things like gold and oil, backed tokens are being launched. Interestingly, the gaming industry and the physical collectibles market, so things like art, wine, very expensive watches, things like that, also things that you would find at pawn shops too, are being tokenized and represented on a blockchain for a number of reasons. The owner registry component is really powerful, but these are also industries that are less regulated than the financial industry, and so they're able to experiment with new technology a little easier. So the barrier to entry for things like blockchain and tokenization is lower in the gaming industry, for example, right, where you may want to tokenize an in-game item. We're also seeing things like software licenses and event tickets, concert tickets, things like that get tokenized as well for all the benefits that I mentioned. So I will stop there and pass it off to Commissioner Peeler.
Thank you.
Yep.
Thank you, Andy. I'm, again, Mike Pichek. I'm the commissioner at the Vermont Department of Financial Regulation. So in Vermont, just as a precursor, I think we've had a long history of being involved in innovation, particularly in financial innovation. Representative Gene O'Sullivan, who's with us in the audience, will know that for sure as it relates to our captive insurance industry, where Vermont is #1 in the world by premium volume, #1 in the United States by the number of licenses that we have for captive insurance, and we have some of the biggest companies in the world. 48 of the Fortune 100 are based in Vermont, and 18 of the Dow Jones Industrial 18 are based in Vermont as well. So captive insurance is something of an innovative financial instrument or program, if you will. As we look at initial coin offerings and cryptocurrency, we're also trying to find ways to be innovative as a state and provide opportunities for businesses located in Vermont and also others that are interested in this space to come to Vermont to potentially with favorable policies. So I was tasked with talking about ICOs, or initial coin offerings, and I'll be brief so that we can get to some of the discussion and questions that folks have. But initial coin offerings, as I like to think of them, are sort of a quasi-public offering, if you will. Those of you in the room are probably familiar with IPOs, an initial public offering. So an initial public offering has to go through a whole regulatory structure. At one point, it was both at the state and federal level. At least as it relates to IPOs, it's now completely at the SEC level, at the federal level. So this involves a lot of time, a lot of money. Obviously, you have to hire law firms and accounting firms and people that are very much an expert in this area to be able to get to the point of doing an IPO. The frictional costs, if you will, that are associated with raising capital in that way are quite high. You see it reflected in the number of IPOs nationally every year has been trending downward. There has been an uptick recently, but that has been the trend for companies to stay private, not to go public. So that is sort of that dynamic that sort of got meshed up with this cryptocurrency phase that and fanatic sort of atmosphere that's happened in the last decade or so. So Bitcoin and some other cryptocurrencies have been around for about a decade. But the ICO market is relatively new, having been, let's say, around since 2013 and really picking up speed in 2017, largely, I think, as a result of the large increase in Bitcoin price that led up to its highest point in December 2017 at almost $20,000 per Bitcoin. So I think small businesses, I think entrepreneurs looked at an ICO as potentially a less regulated or unregulated way of cutting out intermediaries like investment banks and broker-dealers and law firms and all of the other associated folks that it takes to do an IPO, and that they could actually go directly to individuals to raise capital for their business idea. Now, they've had a pretty good amount of success when you're talking about actually raising capital. There's been, let's say, I think it's somewhere between $2 to $6 billion of capital raised in the year 2017. That's up tremendously from previous years. There's something like 50 to 100 ICOs every single month that are coming out where people are trying to raise money. But all that being said, and actually one anecdote, there's a lawyer in Vermont that has a client overseas who actually raised something like $90 million in a matter of seconds doing one of these ICOs. So you could think of an IPO where you're doing a road show and you're on the, you're going across the country for months on end, putting a ton of effort in, and maybe you raise 20 or 30 or $40 million, and here it's sort of a flip of a switch, and you have $90 million in your account to do whatever it is for your business. So obviously, it's something that is very attractive for a business owner or an entrepreneur. So, that being said, I think those of us on the panel probably are familiar with this, both from the industry perspective and regulatory perspective. Many of these ICOs are not legitimate operators. As with any sort of speculative, bubble or speculative investment or just innovation, there's certainly people that try to tag along and take advantage of that and defraud people and make people that are sort of not maybe sophisticated in this new innovation that might be more susceptible to fraud or just sort of a very, very risky investment. So with these ICOs, you see that a large portion of the money being raised is actually being done by a small portion of the ICOs. So those are probably the much more legitimate actors that are doing things regulatorily the right way, that are trying to comply with the securities laws in the country. They're trying to find an exemption, or in some cases now we see ICOs trying to get registered with the SEC, which is kind of a newer phenomenon in the last year or so. So the rest of the crew is either, maybe unsophisticated. They're trying to tag on to this sort of frenzy of the ICO craze and trying to make a quick dollar. But then there's also just the outright fraudsters that are trying to defraud people and take advantage from that perspective. So state regulators across the country, Vermont as well, have been trying to crack down on this type of behavior. We've issued a number of cease and desist, both collectively as states. I think we had something like 45 states issue 100+ cease and desist in the month of May. We called it our cryptocurrency sweep, but it was really focused on this ICO space and these illegitimate actors. And that's not to suggest that they're not legitimate, they're not legitimate actors in the space and it's not a legitimate way to raise money. It's just simply to mention that I think it's our job to regulate this new space to ensure that that innovation can thrive and the people that are trying to do it the right way have the opportunity to do it the right way. So that's really been our focus, let's say, the last year or so, as you see this increase in ICOs. So an ICO, from a regulatory perspective, I think Peter hit it on the head. There's state and federal regulation that they have to comply with. And at the end of the day, even though there's this very new technology and this new innovative way of raising money, they really have to comply with this decades-old Supreme Court precedent called the Howey test, which the fact pattern involved orange groves in Florida and somebody creating and cultivating those orange groves on behalf of other people. And that's really the fundamental legal analysis for determining whether something is a security, an investment contract, basically something that you're investing in for the expectation of profits, where somebody else's efforts are going to determine whether that investment comes to fruition or not. And that analysis holds true in this ICO space. I think many regulators, including the SEC, have taken the position that these are securities, these are investments. They do have to be registered or exempt from registration through the proper channels. And that, has been something that states have been articulating as well as the SEC. So, It's very much still in its infancy. We'll see how, things progress over the next couple of years, whether an ICO does become a new way of raising capital, more traditional way of raising capital, whether, the bad actors in the area are sort of unfortunately clouding the space too much that the legitimate actors might not be able to succeed. Those are certainly things that we're keeping an eye on as the years progress and this becomes a little bit more ubiquitous in terms of an opportunity to raise capital. So I think with that, I'll leave it there and throw it open to questions from the audience or the panel.
Okay, so what I said, thank you, Michael. So if you have a question, kind of mosey on to the front here. In the meantime, and I'm going to ask that whoever you are, tell us your name, where you're from, what organization, if you're a legislator or from an industry, so we'll have some context, so feel free to. In the meantime, maybe to get it started, just on the last point about fraudsters, et cetera, in terms of traceability and recourse, I mean, how traceable, whether it's the state or a private investor or whatever, so how impossible, or is it impossible to actually, because we're not dealing with entities that have insurance product in terms of, I mean, so the traceability of who, in fact, is behind these.
Yeah, that's a great question. I mean, I think many of you are probably dealing in your states with issues surrounding frauds and scams, particularly geared toward the elderly. In Vermont, we've had a great focus on this. We're the second oldest state in the country. And in any of these scams, once the money leaves somebody's bank account, it's almost impossible. This is just traditional scams to get that money back, right? The money goes to a different bank account, gets sent overseas immediately, and it's almost impossible to trace and to recover. When you're talking about a cryptocurrency fraud, it makes it all the more complicated for there to be a regulator that can follow that stream and that can make any opportunity for recovery for an investor. So that's why it's so important to do the sort of the upfront education for consumers and for investors, and for us as regulators to crack down on the fraudulent actors.
Senator, did you have I know Senator Carlucci from New York, maybe and Cindy, you can weigh in as well, or anybody else on the panel.
Yeah, Senator David Carlucci from New York, and I know Peter talked quickly about some of the states doing things right. You mentioned New York State with the BIT license. Could you talk about what you feel about that and what you would recommend New York to do?
So New York was sort of out in front on this issue, and rather than squeeze licensing Bitcoin or cryptocurrency exchanges into their existing money transmission licensing framework, the Department of Financial Services, the DFS in New York, who has a very broad statute that they are free to then use as authority to create new regulatory structures, which is not always the case in every state, decided to use that authority to craft a brand new regulation called the BIT license. Now, from our perspective, that's fine. In fact, we've worked with the Uniform Law Commission to develop a model act specifically creating a different license than money transmission licenses for exchanges, because there are unique issues surrounding running an exchange that are different than running a typical money transmission business like Western Union or PayPal. So a unique license that's different is not a bad idea. However, in the case of the BIT license, I think the DFS may have been somewhat premature, and I think to some extent the drafting was imprecise. And so the residual issues that we have with the BIT license are primarily related to two issues. One, the BIT license requires approval for any material change of business for an exchange. And this is very alien to the way tech companies tend to work. They tend to try things and experiment, and getting permission, which could take as much as 2 years, is an anathema to their business models. Now, I recognize that there's a trade-off here between experimentation and consumer protection, but I think the prior approval process, especially the speed that it unfolds, really makes it a detriment to businesses in this space, and maybe a registration and a very open door policy with the regulator. So, hey, we'd like to do this, might be a better approach rather than asking for permission, just keeping them informed. The other issue, and this is really CoinCenter's bigger issue with the BIT license, is that it was not clear about how it defined the class of businesses that are required to get a license from the class of businesses that are not. And what I mean by that is this. With respect to Bitcoin or any cryptocurrency or token network, there's all sorts of activities you might do. Some of them involve holding people's valuables for them. And this is what like Coinbase does when they hold people's Bitcoin for them. That activity generates risk to consumers, and the kind of risk that is best addressed through licensing. You should only be able to engage in that activity if you go through a background check, if you have minimum capitalization, solvency guarantees, and things like that. There's other activities, though, like just writing software. So you're just writing some of the core infrastructure that powers this thing on the internet. Or just mining. So all you're doing is helping to validate the blockchain. And those activities, they don't generate those kinds of custodial risks because the people performing those activities, the people writing software, the people mining the blockchain, don't ever actually hold anybody's cryptocurrency on their behalf. They simply help build the pipes that allow cryptocurrency to move through the internet. And so we are very concerned that if you broadly interpret the bit license, you could require prior approval or licensing from people doing nothing but writing software, doing nothing but mining the blockchain. And that kind of prior approval, we think, is an anathema to innovation and also doesn't address a pressing consumer protection risk because you'd be requiring costly licensing from people from whom you wouldn't get benefits from a consumer protection standpoint if you were licensing them. But I don't think it was the intent of the DFS to license those persons. I just think the drafting could have been tighter. And the Uniform Law Commission's Model Act, which, as I said, would create a bespoke license for virtual currency companies, I think gets the drafting really tight and really accurate, only requiring licenses from those who have that solvency custodial risk and not requiring licenses from other actors in the space who are essential to innovation in the US.
I was just going to make a quick comment about going back to the traceability issue. And licensees in Washington under our act are subject to regular examination following their very robust licensing process. And so we are finding that you can trace the transactions and the traceability is there. And again, this is, we have to remember with the digital currencies, we have to leave some of the baggage of the bad actors to one side a little bit. And we all heard about, you know, the complete anonymity, the untraceability, and when you really dig in and start looking at these things and regulating them, you'll see that there is traceability and accountability.
Yeah. Just briefly on that. So when I make the analogy to bearer instruments, some of you might immediately think of Die Hard, and was it Alan Rickman's character who's got the briefcase full of bearer bonds, and that's the whole criminal plot there. The idea of bearer instruments has always been that they're very good for moving large amounts of money in an untraceable way. Digital bearer instruments like Bitcoin or these cryptocurrencies that I've been describing are subtly different in that it's almost a registered instrument, i.e. there is some sort of record that's in a way centralized and accounts for all the transactions, and therefore it's less private. But rather than having a company keep the record, as I said, like the DTCC or like Visa or like any centralized database provider for financial products, the record is kept by the public at large. The Bitcoin blockchain, which is the record of all these asset transfers with respect to Bitcoin, or the Ethereum blockchain with respect to Ether transfers, or any token blockchain with respect to token transfers, is publicly available information. You can go and look at that record and see this Bitcoin address sent 5 Bitcoins to this Bitcoin address. Now, if my address and Andy's address are on the blockchain, it doesn't say Peter to Andy, it says X125, a cryptographic address, to X596. But if you ever do identify one participant, you can see their whole transaction graph. So it's a little different than our traditional traceability and anti-money laundering world, where you know that there are accounts at financial institutions and you don't know what the transactions are, so you go to the institution and ask for a list of their transactions. Here, you know what the transactions are, you just need to find out who are the names behind the accounts. And if they've used an exchange that's compliant with FinCEN and the Bank Secrecy Act, the exchange could then re-identify the transactions. So these networks really aren't anonymous. The press has really overhyped that, I would say, with respect to them being black boxes or just good tools for criminals. If you're a criminal, use cash. Bitcoin is not going to be a good tool for you.
Okay, somebody rushes to the middle, I'm going to yield to them, and if there's nobody there, I'll fill in the gap. But since You're there. Why
Hi,
don't you
I'm
take-
Carol Braddock from Los Angeles, California, in a place better known as Blockchain Beach. And the question we have for you as regulators is, when are you going to officially say what a block is? And when are you going to make it so a person can hold a piece of a block? Because you can. And when are you going to teach them that they can see what a ledger looks like? Okay, it's not to you, it's just floating right off of you. Those are great buzzwords. I hear them all the time. But you can actually see and graph a ledger. I'll give it to you next year if you have trouble with it. It'll be on all your attendance tags. But you as regulators have to come to the notion that a piece of blockchain can be seen. It's a decentralized identifier. It's way more important than any cryptocurrency you're ever going to regulate, because it actually identifies people. It identifies their medical records. It identifies their license plates, their driver's licenses. If it's a decentralized record, we have something for it. But you guys have to come to that standard amongst all your states.
The state of Washington is very clear that we're only interested in applications where the underlying activity is a financial service that we regulate.
Okay. I don't see this rush to the middle. Okay, one quick question. On taxation, there was the, we glossed over the fact is, you said in the state of Washington, Cindy, that you had weighed in to characterize it from a tax standpoint, and Peter had mentioned something about I don't have a good sense of. So how is this dealt with currently, both at the state, at any state level, or whatever guidance at the IRS level on taxation?
My comment is just that the Washington Department of Revenue, for whom I do not presume to speak, had followed the federal comment that it would be treated as property.
Okay, it's property. Okay. Sir, you were rushing there, and
my name's Logan, and I work for the Nebraska legislature. So when I think about like Bitcoin and these digital currencies, it's pretty exciting. Like the tech nerd in me is like very excited about them, just because they seem so futuristic. But then I look at some of those hockey stick charts, and the investor in me gets a little nervous. So it sounds like none of you think this is a fad necessarily, but what are the chances you think it could be, somewhat of a bubble, and what are some ways to kind of minimize the risks of that?
Thanks very much for bringing us back to that topic of it being a fad, and I was admonishing myself for not having addressed that particular issue. And these are my personal comments. I think what we're seeing right now is fad-ish, and that's because the ecosystem is still so new and it's evolving and rapidly changing. I'm a bit of a Bitcoin originalist in that I hope eventually what it becomes is the ease of payment system between Andy and myself when we're in different countries, and that we bring the costs of transmitting money down. I live in a state where a very great amount of money is transmitted by our residents to another country, and the cost for them to do that is awful. They're trading a large amount of the money that they have earned in terms of a fee to be able to send that back home to their families who need that money to exist. So I'm hoping that as time goes by, the investors, the speculators, and of course the bad guys will get out of the space and let it go back to its roots of being a much faster and safer and more economical means of payment.
So the cryptocurrency piece of this conversation is just the most sensational piece. And if you were listening to Peter's comments earlier, he said that it's a lot easier to explain by analogy than it is to explain, the inner workings of a combustion engine. It's hard for the media to explain the intricacies of a combustion engine as well. So it's much easier to talk about, the hockey stick in the price, or talk about a hedge fund's, percent return year over year, right? Those are very easy things to communicate very quickly, and quite frankly, it's good clickbait online, right? However, I think the other side of that coin is that a lot of the money that does make it into the space is reinvested into the space. And so what happens as sort of the pendulum swings back and forth between blockchain technology and cryptocurrency every couple of years, right, when we have a price spike, some of that money trickles down into companies that are building infrastructure, really critical infrastructure, like wallets and exchanges and good consumer and institutional tools. So yes, there are a lot of sensational things. Those are often the most visible things as well. But I think if you can peek behind the curtain, you will see tons of investment being made in really, really critical infrastructure. A lot of which is relatively hard to explain and will never make it into a newspaper or a magazine. I also like that I'm the counterparty of all these transactions, so this has been a very profitable event for me. Yeah.
Yeah. Thank you. Lance Clow. I'm a representative in Idaho. I have a couple of questions, and they might sound silly, but Peter, you referenced that you have your money on your cell phone.
Yeah.
So just for a moment, let's assume you're out fishing, and you lean over, and that cell phone goes to the bottom of the ocean. Is it the same as the $500 in my wallet?
Yep, it's like cash, and that's quite frankly the goal. But you don't have to only keep your money in your wallet. You can keep some with an institution, which is why there are companies like Coinbase that are basically like a bank for your Bitcoin. So you might want to have a certain amount on your device and a certain amount with a party who has more robust security practices. There's also an interesting hybrid where you can put the data necessary to transact on 3 devices, and 2 devices are necessary to transact. It's like a voting rule, 2 out of 3. So if you lose your phone in the lake, you go and recover your backup devices, and you'd still be able to transact. That's pretty cool. And maybe one of those backup devices is held by a lawyer or an attorney. Well, I don't know why I'm making that's a bad idea. Maybe one of them is held in a safe deposit box at a bank. So there's all sorts of interesting ways that you could actually try and make your system more robust. Yeah.
My other follow-up, I guess, would be for Mike. You were talking about ICOs, and what I don't understand, because I'm a former financial advisor and a former banker, so my daughter comes to me for all her financial advice, and she's close to a millennial. Anyway, so she's asking me these questions, and I don't understand the ICO. So you go out and they raise $100 million. What do they need it for? And where does it go? And why do they keep it? Because after that, so is that their profit for doing it?
Yeah, so I mean, it's similar to, I mean, in concept, if you think of it as an IPO, right? So you have your registration document saying we need to raise $100 million to build out our distribution network of X, Y, Z, or this or that. I mean, in the ICO space, they put out white papers which sort of lay out the reason for the capital raise and what they're planning to do with the money as well. And in the same way that when the company gets the money from an IPO, you know, that's money for them then to use and build the business in the ways that they articulated they were going to build the business and do it, you know, do what they said they're going to do, consistent with their representations. But yeah, that's sort of.
But so is the Bitcoin, is that an investment in that business?
Yeah, so usually
is that what the speculation is?
Yeah, in these ICOs, there's usually a token issued, right? So Bitcoin wasn't done through an ICO. Bitcoin predated this ICO movement. But when there is an ICO, yeah, that token that you're getting, you could think of it as a stock certificate or whatever. But that token represents your, you know, interest. If it's an asset-based ICO, your interest in that company.
Well, that's enough.
So, as Commissioner Pichek said, Bitcoin didn't do an ICO. Bitcoin's emerged in the world through mining, And that's where they came into the economy. So you would run a computer that helps back up the blockchain, keep the record of transactions. You pay yourself a reward in the form of new bitcoins, and that's how new bitcoins come into existence. These new ICOs, the innovation here, and it's contentious. Like some people, even within the technology community, don't think this is a good evolution. The person who's going to write that software for a new decentralized network, a competitor to Bitcoin, or something that does something subtly different, rather than just having the tokens that will emerge on that network go straight to the people validating the blockchain, in the first block of the blockchain, they create a distribution that goes to themselves or goes to people who gave them money in order to build the software. So an initial distribution, an initial coin offering, is that first block of that new blockchain, them selling off rights to the tokens that'll then travel on that new decentralized network before it even exists. It's a pre-sale. And then they'll use that income, hopefully, from that pre-sale to actually build the decentralized network and get it running on computers around the world. You got to trust them to do it. Very different than having to trust a miner or a software developer on Bitcoin, which already exists and has a competitive marketplace for miners and software developers. It's just one person you're trusting instead of a marketplace.
These are probably stupid questions, I'm sorry. It's from Idaho again. When you say miners, are you talking about the guys that are coal miners?
I told you at the beginning, she
or are we
went to
talking
school
about
in
data
Idaho.
miners, you know? Are we literally talking about
Yeah.
coal miners and gold miners?
So the term miner is somewhat regrettable in the Bitcoin network. It's just one of these things that kind of evolved. There's no Bitcoin corporation to officially name things and get the trademark on them, so the names just pop up. The thing that I'm talking about is people who keep a copy of the Bitcoin blockchain on their computer. So they're part of a network of people who keep copies all over the world, which is why it's redundantly distributed and stored and you can trust it. And they validate the transactions that get added to that blockchain. So they're really performing a function that's not that different than PayPal on any given day, except they're doing it along with thousands of other people around the world. And if they do it fraudulently, they'll get caught because the math won't add up, and they won't be able to receive a reward for performing that function. So they're providing a public good. In order to provide that public good, you need to incentivize people to provide it. And so people who are doing this are allowed to claim a reward of brand new Bitcoins, which is kind of like doing a lot of hard work to get new gold, digging a hole in a mountain. And so we call it mining. But what they're really doing is validating transactions and keeping a copy of the blockchain. That's what a miner does.
Okay, any other questions? Okay, seeing none, why don't we give our panel a round of applause? And I think Andrew was the only one that had a sort of a formal presentation, but I want to say that the presentations, links to any of the materials, particularly Andrew's, are available on the NCSL Summit Agenda and Resource webpage and through the NCSL app, so you can access all that stuff through that. So thank you for attending. Fantastic. Thank you.
So much.